Hi, good morning, everyone. This is Alan Campione. I'm with Life Brokerage. We're going to start in a few minutes just in case anyone is lagging behind. So I'm going to give it another minute or two, and then we'll get going. All right. Hi, everyone. Once again, this is Alan Campione. I'm with Life Brokerage. For those of you not familiar with us, we're a general agency in South Jersey. Just want to take the time to thank everyone for coming out this morning and tuning into our webinar. Jamie Mueller was kind enough to host this. She's going to take a deeper dive into One America's asset-based hybrid LTC product. She is our One American consultant. She's well-versed on this subject matter as anyone in the country. She's a sought-after speaker, terrific educator, and we're lucky to have her today. So she's going to go over a few topics: the power of joint discounts, lifetime benefits, and some unique planning ideas. We're going to hold 10 minutes at the end for any questions, so everyone's on listen-only mode. If you have a question, you could type it into the box, and we'll do our best to answer everybody at the end. Jamie, I'll let you take it from here.
All right, thank you, Alan, and what an awesome introduction. Thank you. So yeah, we are going to dig into One America. You all saw the kind of the promotion sent out by Life Brokerage on this, on how to turn, $100,000 into $1 million of tax-free long-term care. That can actually happen. But the most efficient way to make that happen is taking advantage of some of those things that Alan just said that only One America can provide. I will just, full disclosure here, I am not beholden to One America. I just love them that much. I am a true specialist in asset-based long-term care in general and can put premium wherever I feel it makes sense. Okay, whether it's Lincoln MoneyGuard or Nationwide or Pac Life, you name it, there's just things that One America does from a pure value and differentiation standpoint that really just makes them dominate the conversations right now in this market. So before I show you how we're going to turn that 100,000 into $1 million with a couple of examples, let me just kind of run through for you very quickly why I do look to One America versus the competition. So first and foremost, and we're going to show this on every single example today, is their ability to cover 2 lives on one policy. Excuse me. So what they're doing is they're just setting up the death benefit as a second to die. And when we do that, it just provides practically unbeatable leverage for the long-term care benefits as opposed to 2 separate individual policies. And you're going to see that very clearly today. Their ability to offer lifetime benefits, again, unique to One America in this space. The way that they work with qualified money is very unique. Unfortunately, it's not something, just because of time constraints, I'm going to be able to get to today. Just know that what they've put together is a way for a client to try to do a one-time transaction to fund the overall solution, as opposed to having to manually go into their qualified assets and redirect, say, an RMD or other distribution for the premiums. They're trying to make that a little bit more of a streamlined process. But again, it's a little bit complex. Can't do it enough justice today. But if you've got clients where qualified money is where we need to go for a reposition to get them some long-term care coverage, let's have a conversation with your marketer over at Life Brokerage, and we can break that down for you. The ability to pay premiums to age 100 is something I'm covering today. They're the only player in this market that will allow that. MoneyGuard has a little bit more flexibility. The Minnesota Life Secure Care product, it literally just rolled out the ability to pay up to 15 years. sometimes that still isn't the right solution. And this lifetime premium product that One America has was actually their best-selling product last year. So definitely want to talk about that. And then, the ability to place policies on clients up to table 8. And if you're familiar with Lincoln Money Guard and the like, you know that they're going to shut the door to table 4. So One America does have that ability to get some coverage in place for your clients that just aren't quite healthy enough to get into anything else. And then we do have the ability to place some policies on clients up to age 85, and that is on their annuity care line. We're going to talk about that product today as one of our examples because it is just so incredible what we can do. So again, what we're going to focus on today is showing you that joint life, lifetime benefits, the lifetime premiums, and one of their annuity care products, it's the indexed annuity care, and showing you just how powerful that can be for the right client. Super quick. We will not talk about product mechanics today. That's, an offline conversation because that's not a lot of fun. But just so you know, they do have I basically say they have 2 products, right? They have asset care and annuity care. We're going to cover a little bit of both of those today. The asset care line is their whole life insurance-based product. All that 1, 2, 3, and 4 mean is how are we funding it? It's all it means, but they're going to function the same. And then again, they do have 3 products that are built on an annuity chassis as opposed to a life insurance chassis. And there's a specific reason, why we would go there versus the other. But just to give you an overall idea of what they bring to the table there. Okay, so let's just dig in because we're going to try to make this short and sweet. So I'm going to show you how powerful that joint life design is. So let's say we have a couple, okay? Husband 62, wife is 60. They have $100,000 of non-qualified cash, okay? We're going to work with a single premium here. So what we could do for them at One America is we could put that into what they call their Asset Care 1 product and get them a death benefit of $121,200. Now, could I get that higher? Yes, I can. But what I'm trying to do here is maximize the absolute most long-term care benefit per person that I can. So just know that is a lever that can be pulled if you don't think that's enough leverage for the death benefit. So what that provides them is $4,850, of course that's tax-free, long-term care benefits that is available to both of them for both of their lifetimes. So if just one of them is pulling out that maximum monthly benefit, they're getting over $58,000 a year tax-free. If they're both, for whatever reason, needing to pull at the same time, that's when we're getting over $116,000 a year tax-free out of the policy. We put in $100,000 and we're getting more than that in 1 year. Again, if they're both pulling. So how are we getting this to $1 million? If we do the math, that's 8.5 years of combined benefit between the 2 of them to get us to $1 million. Now, a lot of people say, well, the average length of care is only 2 to 3 years. And my response to that is ask around. If you haven't had personal experience, I guarantee you your friends and clients and other family members have. Me personally, my grandfather had Alzheimer's, needed care for over 12 years. It's just, how are you going to take that gamble, right? Let's just put that protection in place. So yeah, there is a real possibility that we could eventually get them $1 million of tax-free long-term care with $100,000. Worst case scenario, they never needed it. Well, we're going to have some tax-free death benefit to pass on to their beneficiaries. So it is a pure reposition play. We're leveraging that up. We're protecting their other assets. It's really, really, really powerful. But let me show you just how amazing that joint life design is. So what I'm showing you here is how this compares to 2 individual policies with who I consider kind of the major players in the market. So your top line here, right? That's our Asset Care 1 policy, and these are total benefits. Okay, so $100,000 in, right? Here was our death benefit. Now this is, for both insured. They could get $9,700 a month out of this policy for life. The next best that we could do from an actual care standpoint is with 2 individual money guard policies. So putting $50,000 on husband, $50,000 on wife. Okay, we've got a better combined death benefit, but again, that's really not what we're doing here, right? We're insulating their assets in the case of a care event. We'll combine between the two of them, we're at $6,750, and that's for the 6-year benefit duration, which is their most competitive design. Okay, and then the benefits are just going to go down from there. Now, to be fair, right, One America does not win in every single sell. They're not really ever going to be super strong in a return of premium. It's just the way that they design their products. If you need 100% return of premium, right, we can do better elsewhere. But I'll tell you, I've been working with these products for 8 years. They don't get surrendered, not just One America, any of them. Okay, the persistency level on any asset-based long-term care product is extremely high. It's becoming just less and less a part of the conversation when talking with clients, which is why you're seeing, MoneyGuard in the past gave the option to dial that back. Pacific Life is dial that back. And there will be other companies that give you the option to dial it back too, because again, it's just why, when we can get more per month for care. I went ahead and compared this to a non-asset-based long-term care solution because I get this question a lot. Why wouldn't I just go with a traditional life insurance product with a long-term care rider? Short answer to that is, well, you can if you need death benefit protection first. But the only real, second to die product that I can compare this to, where both of them can access long-term care while they're both alive, is with the nationwide no lapse guaranteed SQL. And again, great death benefit leverage because that's what it should do. But just $5,600 a month, is what they could access, but combined for both of them for 50 months. So this is what I mean. Why, if you've got 2 people to cover, we've got to look at One America every single time. It's very, very, very difficult to beat. And it doesn't even have to be husband and wife, okay? It can be any 2 people with an insurable interest, so long as they're not more than 25 years apart in age. So think business partners, siblings, just life partners, same sex, opposite sex, doesn't matter. Been together over a year, we can get this done for them. Okay, so tons and tons of opportunity there. So the next thing I want to jump into is, showing you these lifetime premiums and how those stack up. So let's say we have our same couple here, but they've got, $10,000 that they could put in, and maybe that's coming from, a pension, earned income, if they're already retired, a pension. It'd be nice to retire at 62 and 60. Maybe they've got an income rider somewhere that they can turn on, but they've got $10,000 of some after-tax premium that they can use for some sort of a solution. So at this point, we're going to switch products, and this would be using their Asset Care 4 product. That's their flexible premium product. And again, I'm being very aggressive here on how much benefit I get out versus max death benefit. So I'm keeping that to the minimum that I can do. So their death benefits just over $205,000. And now we're looking at long-term care benefits of $8,200 a month. And of course, those are tax-free per person for both lifetimes. Just absolutely incredible leverage for the long-term care with this joint life design. So now again, if one person's pulling that out, we're at $98,400 a year tax-free. And again, if they're both in, we're just under $197,000 out per year, forever, indefinitely, as long as they need it. Now, this one's a little harder to compare. Well, it's impossible to compare to another asset-based solution because there is no other asset-based solution that will allow that premium structure. So when we're looking at this, I'm generally being asked to see if it makes sense versus, again, a traditional insurance product with an LTC rider. And again, we're limited here, right, on who we compare it to, because most of them, as you know, it's only available for the surviving spouse. So just a quick comparison here again, this top line, this is our Asset Care 4. That 16.4 is combined benefit if they were both to take it. Comparing that to, again, the nationwide no lapse guarantee SUL, fantastic death benefit because that's what it's designed for. And, you know, not shabby, right? Combined benefits of almost $11,000, but for 50 months. So what if we were to split that $10,000 up into $5,000 a year for individual policies? What does that look like? Again, we're doing okay here with the nationwide product, you know, combined death benefit and combined LTC, but again, 50 months. The most popular solution I see this put against is the John Hancock Protection UL policy with the rider. You're going to get, you know, more death benefit because it's a current assumption product and it's not guaranteed. You're still, you know, much better on the ability for the long-term care. And again, I'm using that 50-month option, that 2% of the death benefit option to try to keep this pretty comparative. So again, can't beat it. You know, it doesn't matter where we're looking. If you need to cover those two people, we're going to do the best for long-term care with the One America policy. But look at this. This is very often overlooked. Look at that cash value. Okay, by year 10 with the Asset Care 4, we're at almost $49,000, and that's guaranteed. That is guaranteed at 4% growth per year. The next best we can do is with the John Hancock, and that's the non-guaranteed cash value that they illustrate. Could be more, could be less. So again, super, super powerful solution here. So I'm going to switch gears a little bit, our final topic that we're going to cover today. And this one is probably one of my favorites. And maybe it's because I, you know, lived in that annuity marketing world for so long before I, you know, kind of transitioned into life and then found my home in asset-based long-term care. I know how many annuities are out there. Okay, this was a piece that I found. I'm still hoping to find the 2017 numbers. But just in 2016, there was $2.8 trillion of annuities sold. And now that is, of course, it's a mix of all different types, variable, fixed, index, non-qualified, qualified. But you can see the history of, you know, just the sheer volume of annuities that are sold every single year. But then look at this. This was a 2015 Gallup poll of annuity owners, and they asked them, what are you going to do with your annuity? 73% said they aren't going to use it for the income, which is why they bought it 10, 15, 20 years ago, however long. It's their rainy day fund. They are sitting on this annuity just in case they get sick, or specifically, it's their emergency funds for catastrophic illness or nursing home. These clients are literally telling you that there's an opportunity here, like just handing it to you on a silver platter. How often does that happen? So if you just do some quick math, I mean, just of the annuities that were sold in 2016, if that trend holds true over time, I mean, 2.1 trillion of those at some point could be open for a distribution. And again, think of how many that have been sold. So before I explain to you, you know, how this works with the Pension Protection Act, one of the most common comments that I get back from advisors is, well, I don't write annuities, so this doesn't make sense for me. It absolutely does. You don't have to be an active annuity writer. I guarantee you, you've got clients that have annuities on the books that somebody else wrote for them. Okay, so it's an opportunity. You just got to ask them some questions and then see if this makes sense. And I'm going to detail you who those clients are here in just a moment. So what makes this whole, you know, idea so powerful is the Pension Protection Act. So I'm going to just give you a super, super high level explanation of what that is. So back in 2010, this went into effect. And what the government is saying is, if you have a non-qualified annuity, has to be non-qualified, you can 1035 exchange that into a Pension Protection Act compliant annuity. And obviously that transaction is tax-free. When you accelerate that annuity for long-term care, as they are designed to do, to be compliant, right? These are long-term care compliant annuities. That distribution also comes out tax-free. So what in essence, you're able to provide your client is the opportunity to eliminate the taxes on deferred gains in the annuity that they're sitting on to use for care anyways. And that's why these just move, right? They sell all the time. So just a quick example of what I mean by this. Let's say you've got a client who started an annuity with $100,000. It has $150,000 worth of gain over time, and now we're sitting on a $250,000 annuity. If they were to get in there and just pull out some distribution, whether it's even their income rider doubler provision, right, it's going to be taxed on a LIFO basis, regardless of what you're using it for. So the alternative is we 1035 exchange that into in this opportunity, a One America product is what I'm going to show you. That happens tax-free. And now when we pull out for care, also tax-free. So let me show you an example of what this looks like. Now I'm showing you a different couple this time, okay? And this only because I very, very rarely see an opportunity under the age of 70 where we've got an annuity with enough gains in it where this makes sense. So what you're looking for here are clients with non-qualified annuities with substantial gains. Okay, if there's minimal gains, we can do better probably just cashing it out and going over to asset care as a single premium. So you're looking for substantial gains that are out of surrender, but maybe 3 to 4 years out of surrender for this to still be very, very effective. Okay, so this gentleman is 70, wife is 68, got a $250,000 annuity, that $100,000 cost basis. Here's what we can do. So we're going to do that 1035 exchange. I am using their indexed annuity care product because it does have that ability for those lifetime benefits, and it's the most aggressive we can get from how much care we can get per month with the lifetime option. So here's what we're getting. We're getting them each $5,900 of tax-free long-term care per person for both lifetimes. Never another penny a premium ever due again. Okay, so again, I always like to kind of put this in some bigger numbers. If one person's using this, $70,800 tax-free. If they're both using it, $141,600 tax-free. So, and I'll keep in mind, this was just, say this is just the husband's annuity, okay, just his, and we're covering them both forever, tax-free. Just absolutely amazing. So now I'm going to put this into what I call annuity fee, okay, because again, I lived and breathed in that annuity world for so long. It's all about payout factors, right? What's my payout factor for X age? So look at these numbers, 28.3%. If we were to have left that $250,000 annuity where it was, that's what that annuity would have to pay out after tax forever to generate that annual benefit, that we're providing them for one person. For both people, if they're both pulling that $5,900 a month, that annuity has to pay out 56.6%. Again, forever after tax. That annuity does not exist. If it did, every single one of us would have one. So a couple of weeks ago, I asked a friend who's still in the annuity marketing, side of the house, what is a great income payout factor for a 70-year-old? 6.5%. That's your income rider, payout factor. So that is why, again, these opportunities move so easily. Okay, they have an annuity, they believe in annuities, you're moving into another annuity with an absolutely phenomenal payout factor should they ever get sick. And again, if they don't get sick, well, guess what? You've got an annuity that has all of the same benefit, options for your beneficiaries that your current annuity does. So you're not losing. It's just so amazing. So I always like to kind of cover this, and I probably didn't do a great job as I usually do of making the point that this was just the husband's annuity. So when I do, never fails. I can almost hear the fingers typing on the keyboard. Well, wait a minute, Jamie, that doesn't make sense. Can't do that. You just broke the 1035 exchange rules. Go drink some more coffee. Well, we can. And we're able to do that with what One America calls their eligible person. So what we're doing here is the 1035 exchange is still coming over to One America with the husband as the annuitant and the owner. So that's how we're not breaking the 1035 exchange rules. we're adding the spouse, and in this case, it does need to be a spouse without a lot of special exceptions to be made. We're adding her on as just what's called an eligible person. She's not an annuitant, she's not an owner, she is eligible only to receive the long-term care benefits as illustrated. What's important to do here then is to make sure that our spouse is also our beneficiary. Okay, so if husband passes away, then she has options, right? She can do a spousal assumption on that annuity and keep this going for her entire lifetime if that's what they chose to design it to do. Or again, she can do whatever she wants, right? It's now her annuity. She can cash it out. She can go live in Belize. It's totally up to her. So again, very, very easy to get up to $1 million of some tax-free LTC using this one, just because again, the leverage is so amazing, and just that ability to get it out tax-free. So just a couple, those are three, I would say, of the most successful ways that I see people utilizing One America. Again, taking advantage of that joint life every time, whenever possible. Being able to spread those premiums out to age 100 is extremely popular. And a lot of times we stack them up, guys. We do both, a little bit of both. Okay, maybe they still need some death benefit for protection. We're putting them in a very affordable life insurance product, and then we're using a portion and we're funding an asset care for to cover the long-term care component. I mean, there's so many different ways we can plan with One America, and that's why, again, they just dominate the conversation right now. So with that, Alan, I'm done. I'm sorry I went over a few minutes, but I think we've got a few minutes for questions if you see typed into the box.
Okay, yeah, it looks like I don't see any questions in the box. So if anyone does have any questions, you can type them in now and we'll get those answered.
Maybe I just did that good a job, or it's just that too early in the morning.
Ooh, we do have one question. Can you explain briefly the use of qualified funds? Yes.
And again, it's hard to do this without some visuals, so I will try my best to just do this verbally. So, with these products, the way that they work is you've got a death benefit component, and then you've got a continuation of benefit rider component. And those two pieces together is what makes the whole package, right? The ability to go lifetime even with the rider. With the qualified money solution, which is their Asset Care 3 product, they're adding a third component to the puzzle, and it's a qualified annuity. So that annuity acts as like a catcher's mitt, if you will, for a qualified rollover. And what One America is going to do is they're going to spend that qualified money down in 20 equal distributions. So they're still going to get taxed on the qualified money over time, but it's a consistent amount every year that they can plan on. But that distribution does two things. Number one, it satisfies RMD. If that's the case, then they need to be doing that. But it's also serving as the life insurance premium. So again, spreading out over time and still funding the death benefit. Where it gets complex, and again, where there was no way we would have had time to cover it today, is we still have to figure out how we're now going to fund the continuation of benefit rider portion, because it has to be funded with after-tax dollars. And I have multiple ways that I can help show you guys how to do that efficiently, so that it isn't, overwhelming or, it's kind of a pain for your clients on how to come up with that money. We have some very great ways to get that done and still make it relatively seamless for your clients. But that's an overall idea of what they're doing here.
Thanks, Jamie. We do have one more. How does the death benefit work and benefits at first death?
If we're talking about the qualified money solution, then it depends on when the death benefit's payable. Okay, if it's payable, well, first of all, let me say this: if it's a single life policy, okay, and a death benefit is payable in the first 20 years, there's going to be two benefits payable. Okay, they've got whatever is in their qualified annuity that's treated just like any other qualified annuity, And then whatever now has been funded into their life insurance portion pays out tax-free like any other life insurance. If we set this up on a joint life design, nothing happens on the first death. If they, don't want it to, if they want to keep the policy going, everything just continues as is. And then upon the second death, then the same issue applies if we're in the first 20 years. Now, once we're past the 20-year spin down, all we have now is a fully funded life insurance policy. So everything is tax-free at that point. Now, if you're working with any of the other products and we're funding with non-qualified money, it's obviously just a tax-free death benefit at any time that it's payable, single life or joint life.
Okay, and there's one other question. How much would you estimate the joint policy discount to be?
Oh my gosh, significant. On average, you're adding that second person onto the policy for about 20 to 25% of the premium they would pay on their own. I see it all the time where maybe we put in a joint life and for whatever reason we wanted to change to a single. Maybe one of them didn't get qualified and they think the premium is going to be cut in half. It's not. It may be dropped by 20, 25% at the most by removing that second insured. So it is incredibly affordable to do that second person on there.
Yeah, it's very impressive.
Any other questions? I think we've maxed them out on time here.
Yep, it looks like that's all the questions we have. Jamie, thank you. I really appreciate it. Everyone who joined today, thank you. I will distribute this webinar out. We did record it, and reach out to you if anyone has any other questions after we jump off the call. Thanks, everyone.
All right. Thank you so much.